Hey guys, welcome back for a new video of mine on my little YouTube channel here. In the Market Pace channel, I hop on every now and then and explain a couple of the recent factors going on in the stock market, my opinions of them, as well as what I'm doing about it to kind of capitalize on it based on what I know about the market over the last several years of experience. With that being said, this should not be taken as financial advice. The stuff I talk about matches my sort of risk and reward that I'm looking for, and it's trading that's very tailored to what I like to trade, which of course is very likely not true for people watching this video. As well as real financial advice does take into account personal factors like your income and your financial goals, which of course I know nothing about. And I always do encourage people to reach out to a financial advisor and work out getting a foundation for your investment plan, and then from there educate yourselves to increase your results from afterwards. With the disclaimer all finished though, this video is about what I've been doing lately, which is about a week now. As soon as I posted my last video, that exact day was when the next step forward happened, which would be going into another leveraged position in the SPXL ETF. I've been there about a week. It's been working out pretty well. I'm already back to a positive result in my portfolio. So nothing really to complain about. So far, so good. Do want to look into the charts though of this whole thing. Here we are with the chart of the S&P 500. And as you can see with the arrow, this day, April 1st, it hit a new all-time high. So that is when I got into another leveraged position in the SPXL, because this all-time high was with an all-time high in the transports. So here are the transports. So April 1st, it closed at an all-time closing high. It was a few points away from an actual all-time high. However, as long as these are very close to all-time highs together, then the whole Dow Theory stands true. So seeing that, I got into another leveraged position in the SPXL, which we have pulled up here now, and you can clearly see so far it's done pretty well for a week. Roughly it's at about 8% gains, which makes up for the 4% loss I was riding in the last video. Which, let's see, yeah. So at this point, we're now kind of back in the black over the last two trades, and we're really in the black when you count the last three trades, with the last time Dow Theory had signaled around November, December, and that resulted in a 26% gain trade, which is definitely nice. And a little checkup on the other averages. The Dow Jones Industrial Average on April 1st was also budding up right against the new all-time high, so that looks pretty good. Hit new all-time highs literally the next day as well, so that confirmed everything. And then here I'm showing the Nasdaq chart as represented by the QQQ ETF, which is kind of one of the better charts I could grab easily. This is the only chart that wasn't at an all-time high at that same April 1st date. However, since then it's gone straight up, and we're butting up right against those all-time highs right now, which is confirming the whole Dow Theory move as well. And I've probably explained in a couple other videos here and there, but I'll just say it again. I like going off of the S&P 500's movements the most, as opposed to the Nasdaq, which is extremely concentrated in technology type of stocks, so it kind of gives a biased opinion. Or the Dow Jones Industrial Average, which is only based on 30 stocks, so it gives a very narrow, closed opinion about what's going on in the market. The S&P 500 is very broad over 500 stocks, and it's fairly balanced over 11 different sectors, 11 different industries. So it kind of gives the best overall view of what the economy is doing in a numerical sense. And we're still watching the dollar, as I've been saying in several videos. As of late, it has been going down. Hopefully it keeps that trend. That would be very bullish for stocks. And we are still watching ETFs like TLT and ETFs like BND, which give a good value and a good way to look at in a chart what are the bonds doing as a whole. And we can see that prices are starting to catch some support and work their way back up, which again is something good we want to see for the stock market. This will be bullish. If they do start to rise, then the whole worries about interest rates rising too fast or too far becomes less and less. As bond prices rise, their yields will go down, their interest rates will go down, which has been a pretty big concern over the last couple weeks to month. So here we have a yield curve. This is something I don't really talk about very often in my videos, but it is a pretty neat and easy to see thing to know about. Just the difference of a inverted yield curve and a normal yield curve. right now what we see here is a positive one. It's an exponentially rated upwards, which is what you want to see. As durations of these bonds get longer, you want to see their interest rates being higher. Each of these dots is the interest rate for a 1 month or 3 month, 2 year, 5 year bond. So as the time goes on, the longer the duration of the bond, you should get a higher return. That's how this typically works. Now every now and then this yield curve is inverted, where the shorter duration bonds are actually a higher interest rate than the longer duration bonds. And then that inversion has predicted just about every major recession, including this last recession. It was inverted around September 2019, and about 4 or 5 months after that is when the COVID crisis began, which some could say is a completely chance encounter or chance happening. Yet somehow the bond market did predict it about 4 or 5 months before, seeing that there's some sort of trouble on the horizon. And it proved itself right for sure. Of course, that's not the case right now, though. We have a normal yield curve, which demands that longer durations must pay higher interest rates than shorter durations. Typically, the reason for this is an investor that's putting their money in a bond for 3 to 5 years wants a better return than someone who's putting their money in a bond for 3 months. And the market will help you match this, because there's always a risk-reward type of ratio that's sort of unspoken, in my opinion. With a treasury bond, you're taking no risk, but you're getting more reward over time, as opposed to a short duration treasury bond. So for the market to match that with its overall, much better returns, however with much more risk, it would have to have a better return over the next 5 years, 3 years, than over the next 1 to 3 months, which is normal. That's exactly what we would expect for a normally healthy stock market to do. Have more of a gain over 3 years as opposed to having a bigger gain over 3 months. So when you look at the yield curve and see that it's steep like this, mostly things are healthy, albeit these interest rates are low. That's never really stopped stock markets from going higher in any other country that has lower interest rates than us, like Europe. So I wouldn't really be too worried about the interest rates being low until the next 2 or 3 crises that will push those interest rates even lower as they try to stimulate the economy the way they always do with lower interest rates. And that's basically everything I got for the video. Just in that leverage position, so far it's going good. Made back pretty much all my losses from the messed up one a week or 2 ago. I am having a small regret of doing that shorter stop loss at 3,900. I think I probably should have stuck to my usual go at just a 5% loss. In that case, I would still be holding on to the original position and would have even more of a gain and never would have taken a loss at all. But it's not the biggest regret I've ever had, so I'll live with that for sure. Anyway, outside of all of that, things are looking good for the stock market. Keep an eye on the dollar, keeping an eye on the bonds. But so far, so good. I'll keep you all in the loop best I can with my videos. But until next time, y'all stay safe out there and happy trading.